Most people think wealth is about owning things, money, property, stocks. But real power lies in how control is distributed across assets. Control determines who decides, who benefits, and who absorbs risk. The wealthy do not just accumulate assets, they structure them intentionally. Don't forget to like and subscribe, because understanding how control flows across different assets reveals why some people stay wealthy while others remain exposed despite having money. 1. Ownership does not equal control. Many assume that owning an asset automatically means controlling it. In reality, ownership and control are often separated. Public shareholders own companies, but executives and boards control decisions. Property owners may face zoning laws, taxes, and regulations that limit control. True wealth focuses on who holds decision-making power, not just legal title. Control includes authority over timing, use, leverage, and exit. 2. Cash provides flexibility but limited influence. Cash is the most liquid asset, offering speed and optionality. However, it provides limited long-term control. Cash loses value through inflation and earns influence only when deployed. Wealthy individuals hold cash strategically, not excessively. It is used as a positioning tool rather than a store of power. Control through cash comes from timing and access, not possession. Those who rely solely on cash are reactive. 3. Businesses concentrate operational control. Operating businesses provide high levels of control when structured correctly. Control comes from ownership stakes, voting rights, and management authority. Majority ownership or special voting shares allow decision-making power even with limited capital exposure. Business assets allow control over cash flow, hiring, pricing, and strategic direction. This is why elite wealth is often anchored in private companies rather than public markets. When structured well, they become engines that convert effort into scalable power. 4. Equity separates economic and voting power. Equity is rarely uniform. Different share classes distribute control unevenly. Founders often retain voting control while selling economic ownership. This allows capital raising without surrendering authority. Public investors gain exposure to profits, but little say in operations. Understanding equity structures is essential to understanding power. Wealthy individuals seek voting rights, board seats, or control provisions. They value influence over dividends. Equity without control creates dependency. Equity with control creates autonomy and long-term dominance within systems. 5. Real estate balances control and regulation. Real estate offers tangible control over physical space, but it is heavily regulated. Control depends on location, zoning, leverage, and legal structure. Direct ownership provides operational control, while syndications or funds dilute decision-making. Wealthy investors often separate use control from economic exposure through trusts or holding companies. Real estate becomes a stability asset rather than a power asset, unless paired with strategic positioning. Control is maximized when properties influence access, logistics, or scarcity rather than purely appreciation. 6. Debt shifts risk without surrendering control. Debt is a misunderstood tool of control. When used intelligently, debt allows asset expansion without giving up ownership. Control remains with the borrower as long as obligations are met. Wealthy individuals use fixed-rate, long-term debt to lock in predictability while preserving upside. Debt transfers risk to lenders, while control stays centralized. However, excessive leverage reverses control under stress. The key is structure, not avoidance. Properly used, debt amplifies control rather than weakening it. 7. Legal structures. Centralized decision authority. Trusts, holding companies, and layered entities exist to concentrate control while dispersing risk. Assets may appear fragmented, but decision authority flows upward through legal design. This protects wealth from lawsuits, taxation, and operational exposure. Control is embedded in governance documents rather than names on titles. These structures allow continuity across generations. True asset control is invisible, contractual, and intentional. Those who ignore structure often lose control despite apparent ownership. 8. Intellectual property creates silent control. Intellectual property grants control without physical presence. Patents, licenses, trademarks, and proprietary systems generate influence across markets. IP allows others to operate while paying for access. Control is enforced legally rather than operationally. This makes it scalable and low exposure. Wealth built on IP is quiet but powerful. Control flows through contracts, royalties, and restrictions. This is why elite capital increasingly favors ideas and systems over tangible assets. 9. Time horizons define control strength. Control is strengthened by long time horizons. Short-term assets prioritize liquidity but sacrifice influence. Long-term assets allow compounding authority. Those who can wait control outcomes because they are not forced to act. Patience becomes leverage. Wealthy individuals structure assets to reduce urgency. This allows them to dictate terms rather than accept them. Time-aligned control is often invisible but decisive. Those without time are controlled by circumstances. 10. True control is distributed, not concentrated. The most resilient wealth distributes control across asset types. Cash for flexibility, businesses for influence, real estate for stability, equity for growth, and IP for scale. No single asset provides total control. Balance reduces dependency and risk. Distributed control allows adaptability across economic cycles. The goal is not dominance in one area, but optionality across many. This is how elite wealth remains stable, quiet, and enduring across generations. Control is the hidden architecture behind lasting wealth. Assets are tools, but structure determines who decides, who benefits, and who survives volatility. Don't forget to like and subscribe, because understanding how control is distributed across assets allows you to build wealth that is resilient, strategic, and quietly powerful rather than exposed and reactive.